What we're going to be covering today is Vlad and Yulia are going to come on and share about their use case. So they're business owners, and I'm going to let them introduce themselves in just a moment. But they're business owners with a really cool business and also using infinite banking to support that business, right? And we've got about a half an hour with them today, so we're going to let them kind of take the show here and talk about their situation. And then if you stick around, we're going to be covering equipment financing, which for any of the business owners out there, or even for people that are just personally financing major purchases, the use case in Nelson Nash's book about equipment financing, we're going to dive deep into that. With all of that said, welcome Yulia, welcome Vlad. Glad to see you out here. And do you want to just give a quick introduction about yourselves and kind of what your business is all about?
Sure. Hi, Craig. Thank you so much for having us. We really, really appreciate it. And hello, everybody. So I'm actually going to have what I call the big guns talk, and that's where I'm going to hand it over to my father over here. And then I'll explain a little more on that. Papa, do you have more to say?
Absolutely. So I would like to start with our introductory and our introduction stuff. And so my name is Vladislav Ivanov. So originally I'm from Russia. For last 25 years, we living in the United States in the north part of New York. So we are from dance industry. So what we're doing, I think, the best job in the in the whole world. So we are creating strong and good community for like people who never meet with each other. So we're doing some dance business, it's like, so ballroom dance studios. It's what we developing right now. We developing state of Pennsylvania. We developing state of Delaware. We have opportunity to opening new locations in the state of California. So what is our mission? Of course, it's like enrich people's lives through the dance. And before, of course, it's like I'm start my career when I was 9 years old. My mom, she bringing me on a dance floor, and I really was interesting to just trying myself with new hobby, with new activities. And I love this kind of thing so much. For right now, I'm already 50 years old, and I'm doing all my life. I'm doing some dance, it's like activities, ballroom dance activities. It's when people dancing in the couples, when people able to just communicating, not just through the words, when people able to communicating with the movement, with the music. And in the previous presentation of Chris, it was something about timing and energy. It's exactly what our business creating. It's like, so time, it's always for us, it's connecting with the timing. Timing always connecting with the, it's like how we can to reach each other and how we can to just creating good foundation for level of communications. So last 10 years, we start to new venue for ourselves, and we start to developing and opening new locations and new studios. So right now we have 12 locations in the state of Pennsylvania, and it's in different areas. And we just creating because we have system, we have strategy, we have people, and of course we have a lot of additional programs for University of Dance when we just give opportunity for new people who is interested to be in the new businesses, so we give some opportunity to working with us as well. So 5 years ago, we was on one of the presentation with Brent and Hannah Kessler, like making some presentation, and it was interesting performance, like, and from beginning, I'm just myself and Julie actually was there, right? It was one of the Bill Welsh activities, and it was very powerful. In that time, I don't know what I can to do with all this kind of thing. Lately on, I'm purchasing several books, and I'm start to learning, looking how people acting, and I really start to creating some kind of ideas about how we can to use this kind of strategy in our business. Before we start to do anything with our business, we start to creating some kind of policies from our families. Here it's myself, it's like my wife Karina from left side, Julia from right side, and we have the youngest one, it's Yana. So Yana, she's 15 years old, Julia 22, myself 50, my wife, she's 49 years old. And all of us, of course, we from dance industry, all of us, it's like, so we have professional level of the dancing.
Dad, but you can't forget our main guy in the
Yes,
family.
it's
It's
from
our
right side.
puppy. It's Misha.
Yeah, so and Misha, he's just one of our guy who is just, like bringing all of us together. So everybody, we have responsibility in front of him because somebody need to care of him, somebody need to feed, somebody need to walking outside. So it's part of our family. And of course, in the moments when like we start to thinking about how we can to create this kind of system for ourselves, I'm start from myself and I open my first life insurance policy. And I don't know how I can to use, it's like, let's say this kind of policy on a 10%. I don't know how to use on a 20%, on a 30%, 40%. But since I'm open this kind of thing, I really start to find so many new angle of my vision start to be changed because I see how uh, it's like how I can to use this kind of system not just only on a local level, how I can to just like connecting myself to my wife, how I can connect this kind of thing to my kids. And it's like our first policies we purchased maybe 5 years ago, and it was just part of our start. It's like so we start with small amounts and we feel just comfortable to check it how good it is. So after first year, we see huge improvement, and I'm start to talk to everyone, guys. It's like so. Can you imagine if all of us will have, it's like second policy? So how much we can to covering and how fast we can to improving part of our, it's like dreams. It's like in the life. And then we also connect to very strong and powerful team. Name of the team is Legally Mind. So it's guys who just it's like we also was on one of the business presentation, and they are just recommended for us to thinking about family trust. It's like so, and we start to creating some kind of association how we can to connect, let's say, life policy with the family trust. And when we just connect two things together, so our machines start to be maybe twice more powerful. It's like so we see how we can to just not just getting some kind of benefits from life insurance, we also can to getting some asset protection. And this was very, very powerful and very strong, it's like subject for ourselves. And then, so we start to second policies we already open. It's under the family trust, and family trust it's already give. We put all kind of companies and all kind of activities what we're doing on our family level, and put everything under the family trust. And we have very good team, who is supporting and help us with any questions. And we're so happy so far. Of course, when you're coming more deeper, more questions it's coming. And
Yeah, and Vlad, I think that so you've kind of laid some really interesting groundwork where you heard about this concept, you started digging into it, and you started on the personal side before you got into the business, right? So you started building personal policies for that legacy, for the asset protection, and then you put a trust structure together, and all of those policies you said went into that trust. Now, I'm just kind of curious, what did you do with those personal policies? Did you start financing things that you needed in the family, or what was kind of your initial use of those policies you created in the family?
absolutely. And previously we work, it's like, and we thinking about we work smart, but it's like after, it's like when I'm just start to making more researching, I really start to understand. So everything what we're doing so hard. It's why, it's like we start to use this kind of life policy, and I see how fast we can getting any results what we plan to do. For example, Julie, you also can sharing maybe with your experience because it's like so right now it's like of course we're paying it's like Julius University it's like through the life policy it's like and it's very powerful and very strong and right now we're thinking about how we can to prepare ourselves for Yana for our next one for plan to be in college.
So yes, when we first opened up our policies, before he mentioned, before our trust came into place, we all had policies individually. And me personally, I used those policies to fund my my university education. I'm currently in a master's program, so taking out loans from my policy to use for education was a big thing for me as well. And as mentioned, yes, before. I have a younger sister, which as soon as I end university, she's going into university. So it's going to be a whole system where we use our policies to fund university, then to pay us back later.
Excellent. And it's
And I
also
think that, if I mind just say too, because I think that's a really, really important point to stress is how you're using the policy and you'll pay it back later, but you do plan on paying it back. It's like you're in control of that banking function, right?
Yes, absolutely.
So, yeah,
So even if I like take out a policy or if I take out a loan from my policy, I'm able to put some extra interest for me so I can gain some money off of it. And I just kind of created a monthly payment schedule in terms of how I can pay myself back over the years. And it's less of a risk for me in terms of kind of just paying the university and then that money is gone.
beautiful.
And also, Craig, if I may say something about segregate bank account, it's like if previously after our first life policies, it's like for each of us, so we have several different accounts. But when we really start to, it's like all kind of activities under the trust, so we have one segregate account. So it's our value start to be much more powerful. And it's like so right now we're not talking about just it's like part of like projects when we can afford some kind of university or when we can to afford, let's say, buying a car, it's like, so we already able to just creating some kind of just bigger projects, it's like how we can to just using this system, it's like it's in a more powerful way. So, and of course, it's like after, it's like all this kind of thing, and I just want to say thank you so much for Chris, for Craig, it's like because it's unique people, it's like, and it's a very supportive team, it's like, and every time when we have some meeting together, it's great brainstorming. And later on, I'm also just introduce and explain part of my business situation, and it's like, and all of us together, we came, it's like on a next level, and we already started creating some business situation. Next one, yes. So it's what we call, it's like it's part of our company name, it's like and of course, it's like, so we have several studios who is just, it's like have escrow accounts, it's like, and usually we using this kind of escrow accounts for, let's say, if students buying any kind of programs and for some reason somebody changed mind, it's like, so we have to just give some kind of refund back. So we call it like our escrow accounts, and it's for each studio. So we have right now actually around United States, around maybe 15 studios, like, who is operating under the system. And of course, like, we're creating some kind of funnel together with Chris and Craig, like, so we're creating some kind of segregate account, like, where is this kind of money coming from our actual accounts from bank, and we just put under the whole life policy. So, and this kind of whole life policy I did under my name. So, I'm just put myself under the policy, and then we just creating additional BUSI CVLOG. It's like additional line of credit in a bank, just like for first year of operation, because in our policy we're not allowed to taking money right away during the first year. So it's why we're opening additional account where we can to use same kind of system even in the first year.
So,
So
in Vlad, I think one of the important things to note here is so each of those E1, E2, E3, those are the franchises where the different dance studios are, right? And then there was money allocated in different accounts that you would set aside for funding for that franchise. And in the first thing you kind of shared with us is why am I letting all that money just sit in a bank account when I could put it into a vehicle that's maybe more adaptable and protective for your business. So that's where we had that first initial discussion on how can we flow some of that money from those franchise accounts into your business banking policies.
yes, so
Yeah.
and it was. Can you imagine? It's like for last how many? It's maybe 12 years. This kind of money was just only on an escrow accounts. It's like, so, and this kind of money it was untouchable. It's like, because we never know how to use, but it can be different kind of amount of money. It's like, because it's people buying some programs and it's pretty big programs, and we're not allowed to taking this kind of money because it's part of our responsibility. It's like in front of the our clients. So it's why when we just it's like making whole life policy, we protect the same amount of money. It's like, so we protect all our studio on the same amount. So we didn't touching this kind of money, but in the same time we start to creating new funnel. It's like we start to creating new line of the business how we can to fund it's like additional projects. Of course, our biggest project right now, we right now opening around maybe 2, 3 location. It's like it's every year. Okay, so but our goal to really start to opening maybe around 5, 10 locations every year. And of course, we need some professional staff. We need it's like guys who is interested to be involved. And we have big group of people in Pennsylvania, in actually in Philadelphia. It's guys investors who would like to just invest money in different projects. And I already have 3 great examples how people can to invest, it's like, let's say $100,000, and just, it's like maybe during the first years, they're already able to get around maybe 20, 30% of improvement.
Mhm.
So this one, it's great models, and it's like it's working for us perfectly.
Yes, to
Yeah.
add on to that, as well, I think the main question is how do we use our policies
Mhm.
using our business specifically to fund different ventures, and what are those ventures specifically? Well, as mentioned, we do open up 2 to 3 studios each year, along with we host different events throughout each year as well. So we use our policy, we take out loans from our policy to fund these types of, let's say, events. Some of these competitions that we rent a hotel for, we do all the hotel rooms, food, etc., all those expenses in regards to running an event. And then we basically we pay out the hotel, let's say entirely, and then we're able to make a monthly schedule of how we're going to pay ourselves back into the policy, into our segregated accounts as well with interest. So I think that's kind of one sector of how we use it. And we've learned how to expand it on various different expenses, investments, and things like this.
And it's great.
That
It's great tool for just it's like still keeping money on account, because it's like we just financing through our policies, but lately it's like our company returning money back to us with the percentage what Julia explained. But in the same time, it's like so we have enough money for next project, for organizing next event, and usually we have 4 events. It's like during the year, it's like when we're doing some ballroom dance competitions, and it's great model for just it's like instead of using our personal money, we're using policies money, and then we're compensating during the period of time. Usually it's like 12 or 14 months. It's what we give for ourselves, but it's already including this percentage.
and it's an interesting question because it was like, is there somebody insured under each of these E1, E2, E3, E4 boxes? Although those are the franchises, you could potentially put some, business insurance on some of the key people in these different locations that help run the franchises. But what you started with was a policy on the key person you, Vlad, you're a key person to this business. So that was where the business funding got started is there, so there's a policy just on you that's being used to support all of the businesses. But in the future, it could be other folks helping to run the business, key people. And that's what we've talked about on the expansion, because you're going to run into a point where as you add more and more franchises, we can't get it all into this policy.
It's like next chapter, and
Yeah.
it's like
Yeah.
next funnel, and it's infinity exposure, because so of course it's when we start to just creating some kind of insurances for each of the franchisees, so it's like it's opening next funnel. And of course our next project, it's we're looking forward, of course it's opening more locations, but right now all our locations it's on a 90%, so we renting these spaces, and we're paying landlords rental prices. Our future goal, of course, we would like to build, it's our own McDonald's. It's like
Yeah.
example, it's like, so some kind of properties where we can to just it's like opening some locations and opening additional businesses, and just it's like developing this subject as well.
So you will be offering dance services, but also be a real estate company.
I think it's no it's unstoppable system, and since I'm just guys have this kind of conversation with all of you, you just give me so many new ideas how we can to use this kind of system in a more productive way. And always we can talk about productivity only when we have product. And this kind of example, it's a great product, because it's like this kind of machine, it's working, and we're looking it's like forward to adding additional mechanisms how we can to working more effectively.
Now, just out of curiosity, so you've kind of laid out what you've been doing, which is really interesting, and how you've used your personal policies and used the business policies. You've built a lot of this before you started using infinite banking for business funding. How did you fund those events in the past? How did you fund these capital projects in the past before you learned about infinite banking?
It's a great question. And I mean, I have American Express, so and American Express, I think I already have not unlimited, but I have very high credit score. And of course, we just taking some monies from our credit cards and we try to compensate after each event. And it was very tricky and sometimes it was scared and it was a big risk because sometimes, it's a competition. If it's competition not so successful as we plan to, just, sometimes we can losing money. But in this kind of system, we never can lose anything because so we have double, maybe triple protection, how we can to just be more effectively. And we start to just invest some money even to buying additional, it's like dance floors, lighting, it's like backdrops. So we have full set of the entertainment company who is just right now providing any level of the events we can to organizing, it's everything what we would like to.
Well, that's really neat how, I mean, just kind of thinking about the before and after. So before it was swiping the credit card, sweating bullets if the event wasn't as successful as you wanted. They didn't give you any, I'm sure the American Express wasn't real lenient if you say, hey, can I wait a couple months to pay you back? So, yeah. Perfect. Um, yeah, so then I'm just kind of looking at any questions. If you have any questions, I know we're running short on your availability because I know you guys had another meeting you had to run to. I think the only thing I see is what's the name of your dance company?
So it's Fred Astaire Dance Studios. So, and we're representing state of Delaware, state of Pennsylvania, and right now we're developing state of California.
And it's mainly in ballroom dancing. What other types of dance do you guys teach?
It's the best activities for men and women. If you would like to be in the time, if you would like to create in good energy. So it's, it's like it's very strong and we have unique programs in each of our studios. So we have right now, it's like around maybe 300 studios around the country. We have maybe around 150 studios outside of the country. And so right now we're not just national company, we international company. And it's every year we have huge improvement and we have so many new and very interesting people who just representing company on a very high level. So
Mhm.
people interesting to just to do some kind of activities. We inviting everybody in the Fred Astaire Dance Studios.
Yes, and to add to that, in terms of what we teach specifically, is if anybody's watched Dancing with the Stars before, that's kind of our idea. We teach anywhere from the waltz, the tango, to the fo to foxtrot, anywhere to bachata, merengue, any of those fun dances as well. So yes, we like to say that we teach cha-cha-cha for a living.
What about people with two left feet? Can you help them?
Absolutely, absolutely. We like to say two left feet, three left feet, either way.
All
Yes, and
right.
also, it's like you can go in on fredastaire.com and you can get so much information about us, who we are, what we're doing, and it's if you would like to get the best promotions, let's say you don't know what you can to do tonight in the evening time, and you would like to just have good date with your fiance, with wives, with girlfriends, with boyfriends, wherever, it's like so. It's great opportunity to try and coming and getting some kind of it's like complimentary lesson from us, and also just so just if you're able to mention my name, so it's I think everybody know in our company. So of course we will be able to just providing the best services for you.
All right. Yeah, so definitely Fred Astaire. It's franchise, so you have multiple locations, and then people want to learn dance. It'd be a great place to go. And also, I think this is just a beautiful model for how you've used infinite banking to grow, build your business, be in control of the money, not have someone breathing down your neck on when you're paying back some of those events. But yeah, this has been really helpful. Any last words that you guys have? Any last words of wisdom? Any other things you want to share with the community before we have to
Yes.
part you farewell?
Sure. First of all, again, thank you so much for having us. It's definitely, I know it's hard to describe what we do in 30 minutes because definitely there's a ton of parts and a lot of moving parts as well. But I think the biggest recommendation and suggestion from our family to yours would be get started, see how it moves, and then expand on it. Because you won't, I think the biggest thing, Dad, I think you would agree is we didn't understand it until we didn't set up our first policy. So I mean, we did some background knowledge and background information, but the biggest thing is open up a policy. The first time is the scariest, and then we expanded very quickly from there.
Also, I just want to say thank you so much for just give us this kind of opportunity to be in the front of people. They can, uh, nobody will say to you how much you need to spending for your life policy, but it will changing your life on a, it's like 360-degree. You will be staying in the same way, but you will be learning not just how to riding regular bike. You will be able to learning how to, it's like riding bike in the opposite way. So it will be in the same way, but it's absolutely different. Okay, different results, different perspective, and different energies will be creating because you will understand how important to just using in a more profitable, in a more effectively, it's like this kind of system because it's very powerful if you know what you're doing.
And I think your advice is spot on. Just get started, learn how to do it, and then build from there. That's what we've all done. And what you've done with your family system and how it bled into the business is beautiful. So that's why we wanted to have you on here because you guys did a really good job of getting involved, learning it, using it personally for university and all the other things you did, and now it's really cool to see how you've integrated with your business. So really appreciate you sharing, and
Thank you
Thank
so
you
much.
so much again, yes, for
Thank
having us. We really appreciate it and can't wait to stay in touch and keep moving forward.
And
all
we're ready.
right,
Yes, we're ready for next stage. Okay, so we're ready to move forward and do as much as we can. Just it's like uh, it's like last thing. What if I can say? So
sure.
how this kind of system it can be working individually. It's in each case. This system is working a little bit differently. It's very important to have powerful people around yourself and be in a good circle to making right decisions because you can find so many other people who I'm not sure about what they're doing and how they're doing, and you can see so much negativity about, it's like effectiveness, how effectively you're using this kind of system. But if you're doing in this group of people, I can guarantee huge improvement and huge results. It's great people, very powerful tools, and it's like everybody will be happy.
All right. Well, thank you so much, and we'll look forward to maybe having you on as you expand. We'll have you back on to kind of talk about what you've done and with the latest build out. But with all that said, greatly appreciate your time. I know you guys are both very, very busy running business, so appreciate you coming on and sharing with the community.
Thank you, Craig. Yes,
All right.
take
You
care
guys have a
and
great
talk to you
rest of your
soon.
day.
Thank you.
Thank you.
Okay.
Bye.
Bye. All right. Well, that was pretty awesome. The next piece I'm going to go over is really geared towards equipment financing. So this would really apply to business owners. And then the question I have for everybody, have you heard of this book, Becoming Your Own Banker? And if you have this book, then you may recall on page 51, Nelson Nash talks about an equipment financing model. And I don't know, I just find that part of the book just fascinating. It's really neat how he kind of stitched it all together. Now, if you don't have the book, I'd encourage you. It's a short read, but it's jam-packed full of all sorts of good information. But what I'm going to do is spend the rest of the time going through what we call the equipment financing use case that's in Nelson Nash's book. Now, a while back, Chris and I presented this in one of our, I think, 2-day advanced training sessions, and we really went through and kind of modernized it with updated policies because when you read this book that, Shauna just put in the chat, it's all based on illustrations and data that was from many, many years ago. But guess what? The principles and everything still apply. All right. So with all of that said, I'm going to go ahead and share out my screen here. So with the equipment financing, for those that have read the book, do you recall kind of what the whole methodology was of the equipment financing? It was Nelson Nash talking about how he's buying trucks. So he came from a forestry background, logging, and so he was talking about buying trucks and how he could finance those trucks through traditional financing, just like what Yulia and Vlad were talking about. They used to use American Express cards. They did just bank financing for their events. You could buy a truck for your logging operations through the bank, or you could finance it with your own system. But one of the things I found that people who have gone through this equipment financing model, they get stuck on a few things like what is it, how do the loans work? And then the second thing that I see people struggling with, because I struggled with this too, is wait a minute, if I'm paying a 5% loan, and let's just see what this next slide says, how does this policy loan work? Because if I'm paying a 5%, let's say policy loan, but then I'm paying it back at a higher rate, what happens when I pay this policy loan back? Where does the money go? What happens to this money? I don't get it. And so that's something that a lot of people struggle with in this mode. But I think what I want to do first is, and I know some of you, Christian, I see you out there, many of you out there have heard how policy loans work, but we also have a lot of new folks here. So I want to just take a little bit of time and talk about how policy loans work. So just like when Vlad was sharing, they took a policy loan, they then take that money, put it into an event. That event generates some money. They eventually put that back or make some sort of payment back to their policies. So let's look at the components of our own privatized banking system. And I've got a series of buckets here, and I just want to talk about these buckets before we jump into how loans work and how this equipment financing model works. So you've all heard when you start a specially designed and engineered whole life policy, you're putting money into the premium side or the premium deposits. Now, who out here thinks putting those premium deposits into your policy is a bill? Is that a bill, or is that something you look at as not a bill? I'm just kind of curious. Who looks at the premium deposits as a bill? That's something that you have to pay. Russ, I like that. It's a shift to capital. Terry says no bill. Deposits to my bank. So, and that's just it. This whole program, just like Vlad and Yulia were sharing, it was a mind shift change because they had to look at, I've been traditionally financing things through the bank. What if I took some of the money that I have and I just took it from one pocket and put it in the other pocket? And that's really what we're talking about is shifting money into this asset called a specially designed and engineered whole life policy. And when we do that, we're putting dollars into this premium deposit bucket. Now, when we put dollars into that premium deposit bucket, guess what's going to happen with those funds? They're going to continue to compound uninterrupted even when we're taking a loan. So a lot of you know that I'm working on a project called The Vault. We're building software to help people manage their infinite banking systems, their debt, their major purchases. We're putting an investment tool in there. Working with a developer the other day, he was asking, well, does cash value and death benefit go up every day in your policy? And so for the last 3 days, I've logged into a few of my policies and I just started tracking them. I never tracked them on a day-by-day basis. But you know what's really cool is I looked at policy number 1, and yesterday my cash value went up $47.09. And then I went back in and looked at it today, and it went up $62.47. Now, this is a policy that's been around for 16 years, so it's got some really good cash value growth. That's just the guaranteed piece. The dividend comes at the end of the year, which is a much bigger piece. But isn't that cool how all of those dollars, even though I'm using them, is still in the policy compounding and growing? So that's really the important thing to think about. Premium deposits are going to continue to grow and compound for the rest of your life. Then we have this other bucket. The next bucket is cash value. Now, cash value is not some separate thing. It's really just think of it as a ledger or an accounting number. Because what's going to happen is the life insurance company is going to say you have a certain amount of death benefit available to you right now, and that's going to be listed as cash value. That's what you have available to take as a loan. Now, let's say you have $10,000 of cash value and you take $5,000 as a loan. Your cash value number is now 5,000 because you've utilized 5,000 of it. Now, when you pay it back, that's going to go back up. I look at this bucket no different than the gas gauge in my vehicle or my car. So I go to the gas station, fill it up, it's on F, it's on full. I drive and it goes down. I go back to the gas station, fill it up. That's the same thing that's going to happen with your cash value number. It's going to go up and down, up and down, up and down throughout your life. So if I have a dance company and I borrow money for an event, my available cash value went down. When I pay it back, my available cash value goes back up. So those are the things that are happening inside your cash value. Then we have death benefit. And do you remember when Yulia said, "Hey, we take money out," or she took money out for her schooling, and she said she's not paying it back right away. She is paying it back, but not right away. The life insurance company doesn't care when you pay it back because they're holding your death benefit as collateral. They know that out of 1,000 people born, 1,000 people are going to die. So that when you pass away or graduate, that death benefit's going to be paid out to your family minus any outstanding loans. So that's how the death benefit bucket works. And then you've got this great big yellow bucket called the life insurance general fund. When you take a loan, that loan is coming from that big yellow bucket. It's not coming from any of your buckets. It's coming from that big yellow bucket. So those are some of the different buckets that we're going to be dealing with in terms of policy loans. I want to jump into the vault. So in the vault, there's some calculators, and I'm in what we call our loan officer. And I just want to show you some principles of how loans work. So let's just say, for example, I took a $10,000 loan, and let's say that my loan interest rate is 5%. These change, from time to time. Now, when I have a policy loan, we will have some interest cost that goes back into that big yellow bucket, the life insurance general fund. But we have a different way to handle that. So for example, I can say I want to pay that loan interest annually. So on my policy anniversary, I can pay that interest. Or if I don't want to pay it, it'll go onto my balance going into the next year. So let's just look at some numbers here. I'm not going to make any payments. Over here, you see I have no payments. I have no payment amounts. I'm just simply saying I have a $10,000 loan at 5%. Okay. So now what I'm going to do is I'm going to take you down to the payment table or the payment schedule. A policy loan is unique. For those of you that understand HELOCs are simple interest loans. They're really cool. A policy loan is also a simple interest loan. It's very cool. But what's different about a policy loan is you'll see that my first balance is 10,000. We calculate the interest accrued for that month. It gets set aside, whereas typically in a HELOC, that would get added to the principal balance. Then you would calculate interest for the next month. But what the insurance companies do is they just keep your principal balance. And they take this interest and they just accrue it and set it on the side. Okay. So that's beneficial to you as a policyholder. Now, if I have a $10,000 loan and I pay nothing back towards it, see, I have no payments, month 1, month 2, all the way down to month 12. I didn't make any payments towards this loan. I will accrue 5% of loan interest, which is $500 for the year. Now, I've got this calculator set up right now to say, hey, I don't want to pay the loan interest. I want to tack it on to the principal going into year 2. So you see that my anniversary here at month 13, my principal balance just went up to 10,500. That's how a policy loan works if you don't pay it back. If you don't pay anything back on the loan, if you don't pay any interest, that's what's going to happen. So instead of $41 of interest, now it goes up a little bit because I put that $500 of interest on. All right, let's go back up and say, let's say, for example, you're going to make $500 payments every month because you borrowed money, could be for personal, could be for business, but I am now going to borrow $10,000 from my policy and put $500 a month back into the loan. What does that look like? Well, we're going to put $500 in month one. 100% of that reduces my balance. Next month, I put in 500. 100% of that reduces my balance. So what you're going to see is loan interest continues to be less than it was before. And if we go down to month 12, we now have an interest cost of $337.50, not 500. So isn't it true, by being an honest banker and actually paying our own system back, that $500 every month went back to refill our cash value ledger bucket? The interest cost goes to the yellow bucket if we pay it. But instead of paying 500, now it's 337. So our effective interest cost for the year is 3.3, not 5. So when we talk about the loan interest cost from the insurance company is 5%, but you really aren't going to be paying 5%, this is why. It's because we're borrowing that down. So now we're at 3.35. And this tool will actually show you, if you pay this $500 over the next 21 months to pay that loan back in full, your effective interest rate is 2.33, not 5. So that's just the economics behind the loans. All right, back to slides. Now we're going to start setting up this whole equipment financing that Nelson Nash went through on page 51 of Becoming Your Own Banker. The first thing he does is he says, well, if I'm going to borrow $52,600 to buy my logging truck, I'm paying 8.65% interest for 48 months. He wants to know what the payment is, and he actually has in the book the loan document that shows kind of how that whole truck was financed, what the payment was, what the terms. And so really what we're trying to figure out here is, if I go to the bank and I borrow $52,600 at 8.865, what's my payment? Now think about this. If you go, anyone in the market to buy a new car, anyone out there to finance any big major purchases, this is the same thing we want to do. What would the bank, what would the dealer, what would the finance company charge us if we loan that money? And we want to get this payment amount, because that's going to be what we're going to pay our own system back. Okay, so now that we have this $1,300 in mind, let's just say, for example, the third-party financing company was going to charge us 8.65, but our policy loan is 5%. The question is, if we're an honest banker, shouldn't we pay $1,300 for 48 months back to our own system? Who believes that we should be the honest banker and continue to pay that $1,300 for 48 months? Or should we shortcut it and just say, hey, as soon as we pay our policy loan off, we're done? And so that's the whole idea. Now, small numbers, I'm not going to go into all the details here, but this is just a loan repayment schedule of saying, hey, at some point we're going to pay our loan, our policy loan, back in full. And let's say I've got 5 or 6 months left of $1,300 payments. Where's that $5,220 going? You're exactly right. It's going into premium. And that's what Nelson Nash's equipment financing was all about, is he would capitalize a policy in his case study, he would capitalize it for 4 years. Then he would quit putting premium in. He would go finance a truck and then just use that overpayment of loans to go back into premiums. All right. So Nelson Nash actually talked about logging trucks, but I've got a guy that I work with, and he has a junk removal business. I don't know, is anyone here in junk removal or investor in junk removal? I think it's a really cool business where people buy too much stuff. They put all the stuff in their garage or the storage units, and eventually you need someone to come and take it all away, right? Because we've got too much garbage just laying around. Now, this business owner, I was talking with him and I said, well, what's your cost for a full load truck, a third, 3/4 of a truckload? So they'll charge people different rates for pickups. So if you need a minimum load, they'll come and pick it up for 145. If you have a full load in a truck, it's going to be about 625. So What he started thinking about is, hey, I've got a certain amount of trucks, I've got a certain amount of coverage I can do, but he's like, I want to get more trucks, I want more cities. That just means I'll make more money. So he started building infinite banking systems so that he could start to finance his own trucks, just like what Nelson Nash taught. So he was going to do the exact same thing. Now, from his perspective, if he did 5 more jobs a day at 300 to 350 per job, he could bring in about another 300K gross revenue to his business. So that's kind of what he started penciling out as how can I build a, privatized banking system where I can start to, fund my own trucks. So we remember this 1300. And I know a trash truck costs a lot more than 52,600 in today's numbers, but let's just say that a trash truck was 52,600. We're financing at 8.65%. So we have $1,300 payment. So let's look at the cost of equipment financing mini trucks over time. So the first thing is if we financed our first truck at 52,600, well, it's going to cost us about $9,810 in interest. So we're going to pay $62,410. That's money that left our economy forever. It's gone, right? So we didn't put that through a policy. It's just money that we paid to a financing company. It's gone. What happens if you buy 2 trucks? Well, we've lost 19,620 in interest, $124,000 out the door. What if we bought 3 trucks? Well, that's $187,000 out the door. So you get the picture. The more trucks we buy to scale, the more money we're giving away in traditional financing. And then in Nelson Nash's example that he did in the book, he financed over 30 years because he wanted to keep buying trucks. So what would it look like to buy 8 trucks over 30 years? What if we bought 16 trucks over 30 years? What if we bought 24 trucks over 30 years? So almost $1.5 million in truck purchases over 30 years. I mean, that's all the money that's just gone. It just left the business. It left your personal financing. It just left your economy forever. So the question is there some other way we could do this? Is there a better way we could do this? So what we want to do is think about, and I'm not going to go into every single one of these. Well, we can if you want to see kind of what the numbers look like, but when we do specially designed whole life policies, sometimes we're building it, for long-term growth. Sometimes we're trying to get as much money in and out as we can. So just like I don't know, I tend to use a tailor sometimes. If you go get a suit tailored or you get a sports coat tailored or whatever, it's all based on your build and kind of they're pulling in, maybe making the sleeves longer, shorter. Policy design is the same way. We need to understand your specific goals. We need to understand how you want to fund it, how you want to use it. So we have different ways of building. And so I call policy design number one the Nelly, where we're going to put $40,000 in for 4 years. We're doing what's called a 60-40 split, which 60% of our premium goes to those paid up additions. So I'm not going to get into all the details of policy design today, but just know that there's 4 different models here. Some of them are kind of built with a little bit less aggressive upfront cash. Some of them are built, very aggressive with a lot of cash upfront. So we've got the Nelly, the half Nelly, we've got the Beast and the caffeinated Beast. Okay. So let's say, what if we built a policy or we capitalized $40,000 a year for 4 years and then we put no more money in it? What would it look like? So if we're putting $40,000 a year into our banking system, 40,000, 40,000, 40,000, and then we're not going to put anything else in, we can kind of see what our dividend growth looks like, what our cash value looks like, what our death benefit looks like. Don't get so stuck on the numbers here because this is going to depend on your specific situation, your age, your health, and then we got to go through underwriting. So these are just examples. But if we were to, capitalize it this way, this is kind of what the policy looks like. Nelson Nash built it this way to make a point. He said, what if we capitalize and then we put no more money in? What would that policy look like if we just let it coast until you got to retirement age? What would your cash value be? The point he was making with this is he wanted to show you if I just fund a policy and let it sit there, or if I fund a policy and I use it for financing. And he wanted to show those two different things. If we just fund the policy, and if you're kind of paying attention or taking notes, just kind of make some mental notes of these numbers. If we fund our policy and we do nothing with it, and we get to age 66 here, there will be $398,000 of cash value. That can be supplemental retirement income. That could supplement your 401k or other things that you might be doing. So this is the amount of money that you have that you could use in retirement, because now we're, say, at age 66. You have a death benefit of 622. All right. So all I'm doing here is just laying down we fund a policy, we set it on the shelf, and we do nothing else with it. Now, let's say, I know there's a lot of numbers on the screen here, but for those that are, not my analyticals that are out there, like, hey, I don't know what you're showing me here, Craig, a bunch of numbers. This is what's going on in this design is we capitalized our policy with 40,000 for the first 4 years. And then guess what we did? We took a loan so that we could go buy our first truck. So we're buying one truck every 4 years. So you'll see kind of the math going down the road of we take enough out of our loan, we pay back loan interest, we have a loan balance. And then what happens is we pay our loan back in full, and by the 8th year, we can put in $6,347 of premium. So remember at the beginning of this, I said, if I overpay my loan, where does that money go? Well, Nelson Nash has plenty of room in his example because he's not putting any more premium in. So he can take that full $6,347 and put it into premium. Now, if you can't do that with your policy, then others had mentioned, hey, start more policies. That's absolutely right. You could start more policies. You could put it in your segregated account and use it for premiums next year. So the thing is, we want to try to get as much into that premium side. And just, it might sound repetitive, but can anyone tell me in comments, why do I want to put as much money as I can in premium? What's the benefit of doing that? Why do I want to put money in our premium? Christian says interest, Shane says compound interest, and they're both right. So what we're doing by putting money into that premium bucket, remember in my 4 buckets, that green bucket, that's just going to keep that compound interest. It's just going to stoke that and create more compounding. Yep, so everybody's right. Compound interest, it will increase death benefit. It builds up more interest, absolutely. So isn't that neat how we're simply just financing trucks now by taking money out of our policy while it continues to grow, and then we're putting in all of that extra into premium, and you'll see that every 4 years, 6,347 going into premium, 6,347 going into premium. Now the question is, what does that do to our policy? So here we are at age 66. Didn't we just use the same amount of money we would have given in a finance company, but we borrowed it from our own policy and then paid it back at the same rate? So we're not talking about different sets of money. It's the same amount of money in our system. Look at the cash value, but look at this, 500,000. So look how much money his cash value grew by doing nothing more than just simply being an honest banker and financing his own system. His death benefit went from, I think it was 600 and some change up to 768. So can't we all agree that using the same dollars we would have given a finance company, by simply running it into our own policy, we're keeping more money in our family. We're keeping more money in the system that we can use for supplemental retirement. So I would much rather have 500,000 for supplemental retirement than the 389. So that's the benefit. And I would encourage everybody to go back and look at Nelson Nash's study and just go through these numbers. Now, what I want to show you is we're just going to go through some different examples. So this is kind of the recap of, we bought one truck every 4 years for 30 years. And so if we did third-party financing, $499,000 out the door, gone forever, never to see again. If we used our own system to finance those trucks, we actually gained about $286,000, because I'm taking out the cost of funding the policy and all the other things. So we're just saying apples to apples. Would you rather lose $500,000 or gain 286? That's really the question that we have here because we're using the same amount of money in both systems. We either lost a $500,000 or we gained 286. Now, that's pretty cool, but then Nelson says, well, if it works for one truck, would it work if I bought two trucks every 4 years? Because in our model, remember the junk business with my friend I was telling you about, he's like, hey, if I can get more trucks, I can hire more people, I can serve more people, my business revenue is going to go up. So now what we're doing is we're going to borrow enough money out of our system to buy two trucks every 4 years. Now our overpayment almost doubled as well because now we're putting in 12,694 instead of the 6,000. So the more trucks I buy, the more financing I have, which means the more money I'll have to put into my premium side, which is really cool because we already know what's going to happen when I go look at 66 and it's going to be much more than 389. It's going to be much more than a $500,000. Let's just go see what it is. So now we're financing two trucks every 4 years for that 30-year period. We now have $605,000 of cash value and our death benefits creeping up to almost 917,000. That's pretty cool. Again, we're not really introducing any new money into the equation. He would have spent that for third-party financing anyway. So Paul asks a good question here. Is there a simple formula to predict when the overpayment plan will make the policy go to MEC? So what you will find, and I'm going to hit on this in a minute. It's a really good question, Paul. There's going to be a point where I can't get as much money in here as I want. And I'm going to show you that. I'm going to keep buying more and more trucks until I break. But how do we find out where those MEC limits are? There's not really an easy formula or something we can put in a spreadsheet. It's typically just a quick call. We can do in-force illustrations. We can call the insurance company, ask them how much more room do we have. But we always want to measure, like we always want to know, like, where's that MEC line for us? But unfortunately, there's not a simple just equation that we can give you to say this is where it's going to be. In Nelson Nash's example, he talks about you're trying to do too much financing with not enough capital. And a lot of people, that's a common question. People come back to me and like, what does he mean by there's too much financing with not enough capital? Well, stay tuned because I'm going to show you exactly what that means. So this is the summary of the two trucks. Again, the question is, do you want to have third-party financing of almost $1 million out the door, gone and lost forever, or do you want to gain 340? So this is just the math. There's really nothing magical about it. Is if we use third-party financing, money's gone. If we use our own system, we're keeping some of it. All right, so now if we can do this with one truck and we can do it with two trucks, can we do it with three trucks? So now every 4 years, I'm going to buy three trucks. And this is like feeding right into what Paul was saying is, can I do 5 trucks? Can I do 6 trucks? What point does my system break where I have too much financing with not enough capital? Well, we're able to take 3 trucks. I'm now taking enough to buy 3 trucks and I'm putting in $19,041 in premium. You'll see that happening every 4 years. And at the end of, at age 66, we now have a cash value of 705,000 and a death benefit over $1 million. So I'm sure by now you're all seeing the pattern. The more trucks I finance, the more money I keep in my system, the higher the cash value I have at retirement, the more death benefit I have. Why wouldn't you do this, right? So this, pattern, we're just gonna see this keep going and going and going. So now we're talking about 1.5 million leaving our family, or we keep 390. So that's just kind of the thing. And let's see, Russ says, just doing one truck, you're recapturing $1.04 for every dollar spent. Yeah, and Russ, you're spot on. And one of the things we're doing in the vault, and it should be coming within the next week or so, we've been feverishly working on what's called a major purchase planner. And it's going to do something similar to what I'm showing you here. And it's spot on with what Russ just said is we're showing you how much you're recapturing. So did you get 89 cents for every dollar for the first car you bought? Now that your policy is mature, are you now getting $1.10? Are you recapturing $1.10 for every dollar you spent? It's really a beautiful measurement, and that's really the nuts and bolts of how we're kind of quantifying the benefits of financing. I'm just going to jump through this real quick because this is just using some different policy designs. I want to jump down to, yep, actually this is a good one here. So we're going to do a policy where we're going to capitalize a dump in. So what I mean by that is when you start a policy, you can just put in premium, say every month, every quarter, semi-annual or annually. So you can do premium only, but there's also methodologies where you can do kind of one time and there's also some creative ways of creating it more than one time. But generally speaking, someone might say, hey, I want to put $120,000 dump in one-time funding into my policy along with my $40,000 premium. So this is just a design consideration. So what that means is, well, actually in this case, we're putting everything up front. So I'm not capitalizing over 4 years. I'm just saying, hey, if I have 160,000, can I just put it into my policy and then not pay any more premiums? Now I'm not saying go do this. We're just showing the math of what it would look like. We want to get as much premium in as we can, but in this model, I'm saying, what if we just did 120 and we put the rest in, just 160 all up front? Well, we'd have about 379,000. Do you remember when we put the 40 in over 4 years, we had 389. So we actually had a little bit less cash value by doing a great big dump in right away. We have a little bit less in death benefit too, but the point is, I want to jump down to the third truck because this is where we're going to run into that thing Paul was talking about. So in our first time of buying 3 trucks with this policy design, you can see that we're adding in $19,041 of overflow into our premium side. Look what happens here, 18,731. And Paul, this is exactly what you're talking about is where's that mech? Well, if I tried to put in 19,041 here, I would have mech'd my policy. I can only put in 18,731. So that's where we ran into, this is the exact point that Nelson Nash was saying is you are now trying to finance too many trucks. You haven't put enough capital into your system. You haven't capitalized or put enough money into the premium side to build your policy up. So I can no longer take all that extra money and put it into premium because I would have mech'd my policy, which makes it taxable. So we're about $310 short of putting that in. So we'll have over this 30-year period, we're going to have almost $19,000. Well, actually, the excess, we would have had almost 19 grand that we couldn't, continue to put into that premium side. So how do we solve that? Well, we either finance 2 trucks for 30 years. We don't finance 3 trucks for 30 years. We start more policies or we put more money into this policy to build up the capital. So the whole point is when you read in the book, you have too much financing with not enough capital. This is the problem that you just ran into, you mech'd it. So hopefully that's clear. Hopefully that makes some sense, but I just wanted to make sure that we really stressed that point. All right, so I'm gonna just show you maybe 1 or 2 more policy designs because I wanna show you what's happening in the behavior of the first 2 policies we did a 60% paid up additions, 40% base. What happens if we squish the base down and put more into the paid up additions? Well, that's going to give us maybe some more cash value up front right away. We're still doing the same 40,000 for the first 4 years in this design. We now are putting a lot more into the paid up additions, less into the base. And what's interesting, if you compare a 60-40 to a 75-25, I actually have a little bit more cash value at age 66, even with squishing down the base. Now, I wouldn't say you should always say do a 75-25 versus 60-40. It really just depends, but we're just showing the math here. We're doing a higher paid up additions design, lower base, and it actually looks like we have a little bit more cash value at age 66. So we're going to continue to do the same thing by buying 1 truck, putting 64, 67 into the policy, which is our overflow. And then we're going to go do 2 trucks. We're going to put in 12,814. And then we're going to go do 3 trucks and we're going to put in 19,161. So we're just going to keep showing the same thing over and over. So what's neat is we just proved that with this higher PUA, lower base, we were still able to fully fund 3 trucks every 4 years, and we didn't mech the policy, right? So we proved that out. That was kind of cool. But now the question is, what if we do a $120,000 dump, 40,000 for the first year? So we're putting 160 in year one. We're using the same amount of money. We're just putting it all in at once. And we're doing that higher paid up additions, lower base. Who here thinks we can get away with financing 3 trucks without running out of mech room? Do you think it's going to mech? If you do, put in mech in the comments. Nobody thinks it's going to mech? All right. Well, let's find out. So if we put in the 160, we now have 468,000 at retirement, a death benefit of 704,000. Here we are buying 1 truck, 37,000, plus the loan interest. So we're putting in the 6347 every 4 years. But look at this. Look what happened from the very first truck we bought. We were able to put in 6347. Oh, actually, there's something weird. I'll have to go back and look at the math why that's switched on me. But looks like we can buy 1 truck. We can buy 2 trucks. But when we get to the 3rd truck, look what happens. We were putting in 19,041. Now we can only put in 15,000. So again, this is the mech problem. So how much short were we? We were $3,912 short of being able to put all that into our premium side. So again, let's go ahead and start more policies. Let's put that in a side account for premium for next year. But that's kind of how that works. All right. And yes, Russ, what a terrible problem to have. What if you have too much money you can't get in your policy? So, all right. Marius, any questions that we need to address live? Anything we need to cover?
I think we're doing all right.
Okay.
I don't think I see anything.
All right. Well, let's if you guys have any questions, I know I covered it's a lot of math, and I know there's probably some folks on here that are analyticals like me, and then there's probably some like, what in the world did Craig just say? But what I would encourage everybody to do is to go through and read the Nelson Nash book, go study that equipment financing model, understand how the money's flowing, and if you need to, we'll have this as a replay coming on. Typically on Saturday is when the replays, so you can come back and look through this math, because these are more modern policies, where what you're going to see in the Nelson Nash book is a little bit older policies. But guess what? It's all the same principles. So,
Hey, Craig,
yep.
we got a question here. So someone asked, so for anyone who is probably older, how do you decide whether to have a policy on yourself or a child after the first policy?
It's a great question, and we do strategy calls. So if you want to get on a call with one of our mentors, looks like Marius, you put the link out there to schedule a call. At the end of the day, it kind of comes down to many factors. What are you trying to do? Typically with kids, we can't get as much money into a children's policy as we can an adult. But sometimes it's a matter of, we could do a policy on an older adult, plus maybe we start building out the family system. And it's very similar to what we started this whole webinar off with Vlad and Yulia. They started family policies, and they put policies on the kids and the parents, and kind of went from there. So Craig, with your kids being, say, in their 20s, the way the insurance companies look at this is, are those kids in their 20s, are they dependent, meaning are they still going through college? If they are going through college and they're still kind of dependent on mom and dad, then there's going to be a certain qualification of policy size that we can use. If they are off on their own, they have their own jobs, then they're going to be qualified based on their income, their gross income. So we want to look at, what is that child's gross income, and then what can you do in terms of a policy on that child. But really, to get into your specific situation, Craig, I'd say just schedule a call with one of our mentors. We'll learn more about what your situation is, what you're trying to accomplish. Does it make sense to do some policies on you and the kids? because all of it can make some sense. It just depends on ultimately what you're trying to do. Let's see. So Celia, she's saying new to this, what's needed to start this kind of policy? I'm assuming it's life insurance. Yes, and everything that we just showed you, this is all based off of a specially designed and engineered whole life policy. And why we say specially designed and engineered is there are whole life policies that you can go down, you walk down the street to pretty much any insurance company and say, hey, I want to get one of those whole life policies, and they'll design them in a certain way. And essentially, when they design those policies, you might put in $10,000 in year one and have zero cash value available. And then year two comes around, you put in another 10,000 and you have zero available in cash value. And then let's say in year three, you put in another 10,000 and maybe you have $2,000 available. So you put in 30,000 and you have 2,000 available. That's traditional whole life. That doesn't work for when we're trying to build banking systems. That doesn't really work. So what we do is we structure those policies where when you put in 10,000, you may have access to 6,000. Year two, you put in another 10,000. Now you might have access to 7,000 of that 10,000. Eventually, we get to that efficiency point where you're putting in 10,000 and you might have access to 11. That's pretty cool for a banking system. So Cecilia, to answer your question, it is specially designed, engineered whole life. And what we would want to do is, again, have that conversation, just like, what is your situation? What's your gross income look like? What are you trying to accomplish? Is it legacy? And kind of think of all of the calls. Marius and I, we do a lot of calls every week, and we're typically talking to people that are either in debt, they want to get out of debt. And so there's strategies for that. There's strategies around financing major purchases. So kids' college, vehicles that are coming up, vacations, or even business needs. And then the third one is kind of the investor profile where, hey, I've got some extra cash, want to run that through a policy and then invest it in something like and understand. So all of those things kind of come together. Those are some of the main use cases.
Russ had a good question.
Can a grandparent do a policy on their grandkids if the parents can't do one, or does it have to only be the parent? So Russ, on that situation, there's some conditions, if you will. Some companies allow you to do what's called a grandparent policy, and it's typically a limited amount of death benefit you can put on that policy. There are other methods where a grandparent can put a policy on a child, and we'd want to make sure the parents of that child also have insurance, because that's what's going to dictate what can be put onto the child. So there's some different paths. Now, let's say the parents can't get insured, then there's a certain amount the life insurance companies will allow the children to have. And so there's some dependencies on how to best structure that. And that's one of the things we can do through discussion is, do you want to just do a grandparent type policy? Do you want to try to do a bigger policy? But then that might require the parents to have insurance. And one of the things that we do sometimes is if the parents of that child don't have any insurance, we're big proponents of putting that coverage on there for income protection. So you could do a convertible term policy on those parents, which then allows the child to get a whole life policy. Why would we do convertible term? Well, the thing is, we're not guaranteed to be insurable for the rest of our life. Next year, something could happen that makes us not insurable. By doing a convertible term policy, we lock in our insurability. So I think it's a good strategy to use, and then we can convert some of that term to whole life down the road. So those are some really neat ways to get that done. And yeah, Dex, man, I love that you did some double dipping. So you have policies on the children and then the grandchildren. So yeah, Dexter's done that. That's awesome. So all right, and then Russ is saying if they don't decide to renew the convertible term, whole life is already in place. So the convertible term, there'll be a period of time when you can convert it. You can convert chunks of it. If you get to the end of the term and you've gone out of that convertibility period, yes, that just turns into a pumpkin. So there needs to be some planning around how that gets handled. Let's see. Paul is asking, parents want to pre-plan for possible assisted living. Yeah. So Paul, that can be, whole life can certainly be a strategy of the parents, when they graduate or pass on, that death benefit could then go into, say, a trust structure that then has instructions on how to take care of that child. So that certainly is a good strategy for, being able to provide for them when the parents pass. All right. Well, are there any other questions that you've seen here, Marius? If not, I know we're at time, but any other final questions?
Oh, some are coming in through here
Okay.
in the chat.
Yeah, so Cecilia, the thing I would caution you on is if you've got policies already, so you've got some State Farm policies, maybe some other ones with your husband, what we would want to look at is one, how long have you had those policies? Because I just got done kind of explaining what traditional whole life looks like when you start it. From year one, you're not getting a lot of cash value, but if you have a whole life policy that's been around for 15, 20 years, I don't like to hear when people are exchanging those for other policies because a lot of times those are already efficient. So if you have a traditional whole life policy that's been around for 10 or 15 years, well, it's probably efficient and you can most likely use it for infinite banking. So what I would recommend, Cecilia, is just get on a call with one of our mentors, share those policies with us. We can look at them, analyze them, help you make some decisions on does it make sense to start new ones? How can we use the existing ones? So just be very careful of anyone telling you just because it's traditional whole life to get out of it. We definitely want to do a calculated analysis to see if it even makes sense to do that. And then Arlene's asking for phone number. Yeah, if Marius just put in a link, that'll get you access to book a call with folks on our team. So so that's probably the best path. And then let's see, Shannon Thomas. So what's the difference of IUL? Well, we could spend the next hour and some change just talking about that as well. But IUL, if you look at what Nelson Nash was teaching and you look at that Becoming Your Own Banker book, he specifically addresses those types of products where we don't subscribe to the fact that IUL works for infinite banking. Now, if you have an IUL for retirement planning and other things, that's a whole different ball of wax. But when you talk about IULs versus whole life, you're talking about guarantees versus non-guarantees and being kind of more associated with the market risk. So let me grab a couple videos and I'll put those in the chat. You have to give me a second just to look them up here because we do have some good content on talking about IULs and yeah, here they are. Let's see. So Shannon, take a look at, or anyone that's interested that wants to learn more about kind of IUL versus whole life. There's two links I just posted to videos. One of them is done by Chris Naugle. The other one is done by Chris Kirkpatrick. He spent a lot of time in the IUL world and then realized that wasn't the right place to be. So those are a couple really good perspectives if you want to watch those, get educated more on the differences between whole life and IUL. Yeah, Index, I just saw that link about, I think it was the Bush family in the race car world. They got involved in some sort of pyramid scam on IULs. Yeah, they put in over 8 million and lost it. I haven't read the story, so I'm not quite sure. All right. And then Diana is asking, are the resources for someone to refi or get a HELOC if equity rich, credit poor? So we do have some resources, Diana, that we work with CMG. And I can put their contact information in here as well. I just have to find it real quick. And they can have some discussions about first lien HELOCs, which we love in this community. Just give me a second, I'll find that for you. If you're interested in kind of learning a little bit more about that, Diana, here's some resources for you. So we partner up with CMG who offer a product called All-in-One. It's a first lien HELOC. And I use it personally. I've had one for about 5 years. It's a beautiful tool. So, all right. Well, I think with that, Marius, I think we've gotten through most of the questions and just appreciate everyone being here and encourage you to go and read the Becoming Your Own Banker. Go in and check out that session. But with all of that said, let's go ahead and wrap this up.
Awesome. Sounds like a plan.
All right. Well, appreciate y'all and have a great rest of your day.